evening, Brighter Super and Energy Super members and guests. Welcome to our Fund and Investment Update webinar. It's fantastic you've taken the time out of your evening to hear about the future of our group and our ongoing transformation into Brighter Super. Before I start tonight's webinar, I'd like to acknowledge the traditional owners of the lands on which we're presenting this webinar and pay my respects to their elders past, present and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. For those of you who don't know me, I'm Kate Farrar, the CEO of the Brighter Super Group. This evening, I'll be discussing the future of our group. With me tonight, we have Mark Ryder, the Chief Investment Officer of the Brighter Super Group. He'll be presenting the current investment market and what this means for your super. Tonight's presentation will run for around an hour, including some time for questions at the end, and we look forward to having a really great discussion with you. So please submit your questions by pressing the little blue hand at the top of your screen. I'd like to also advise you that the information we're presenting is general information only. It's been prepared without taking into account your individual objectives, financial situation or needs. You must not rely on the information alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. So what does the future of our group look like for our members? As you know, on the 1st of July last year, the merger of Energy Super and LGR Super formed the foundation on which the Brighter Super Group was built. We then welcomed Suncorp Super to the group in April of this year. On July 1 of this year, our members from LGR Super were the first to transition to the Brighter Super name. Our Energy Super Foundation members will start to see the Brighter Super brand on your accounts in September. With our foundation funds coming together, we are committed to working towards a brighter future and even more benefits for our members. Despite our growth and names changing over time, your experience as a member will remain the same. You'll continue to receive the same great service you've always experienced, and you'll still talk to the same friendly staff you already know. Rest assured, we'll continue to focus on delivering solid, long-term returns to help give you the best possible retirement. We hope you'll notice that our size gives us an edge compared with mega funds and allows us to respond to the different needs of our members. In this rapidly changing superannuation sector, we always want to remain agile and responsive to ensure the best outcomes for you all. Bringing three funds together without sacrificing personal service does just that. So why the name Brighter Super? Brighter Super came about because it represents different elements of each of our foundation funds. It reflects the strengths and values of the three funds and their commitment to delivering the best possible retirement outcomes for our members in Queensland. For Energy Super, Brighter represents the bright spark in the energy industry. For LGR Super, Brighter is the spirit of community that unites the proud Queenslanders who established our fund 57 years ago. For Suncorp Super, Brighter is one of the products that was offered in recognition of the Queensland roots of the fund. As I mentioned, our foundation funds will rebrand to Brighter Super in all communications in stages, with LGR Super earlier this month, Energy Super in September, and Suncorp in the future. Our research shows that members of our foundation funds value the personal approach, and that is what will continue to set us apart. Together, we now have 260,000 members and around 30 billion in funds under management. We're big enough to matter, but still small enough to care. One example of what this means for us as a business is that we're ensuring that every member of our team understands how their job delivers value to our members. This ensures that everywhere in the business, our staff, even those who you don't see day to day, understand why the particular job they do is important in helping real people like you. This means that you're dealing with a fund where the person processing your investment switch request, for example, understands that this task has a direct connection to an important life moment and decision for you at that time. It's this philosophy that we're working to flow through our combined business and make us truly different from other funds. I know that service is only one part of what we do, and all members are interested in ensuring that their savings aren't reduced by unnecessary fees. So I'm pleased to advise you that one of the key benefits we've delivered in the 12 months since the Energy Super and LGI Super merger is a fee reduction. In the past 12 months, we've already reduced total fees and costs for all members by an average of 24%. For our former LGI Super, now Brighter Super members, total fees and costs have reduced by up to 28%. This has been done by removing the weekly administration fee of $1 per week per account, which means that members are now only charged the annual percentage-based administration fee of 0.18%. We've reduced the administration fee cap from $1,575 to $900 a year across all accounts held by a member during the financial year. We've reduced the investment fee for most of our investment options, including MySuper. So as an example of this benefit, as you can see on the screen, is that a member with a super balance of $150,000 in the MySuper investment option is now benefiting from an annual reduction of total fees and costs of approximately $307. For Energy Super members, fees and costs have reduced by up to 29%. This has been done by also removing our weekly administration fee of $1 per week per account, which means that members are now only charged the annual percentage-based administration fee of 0.18%. We've reduced the investment fee and indirect cost ratios for most of our investment options, including MySuper. For members in the MySuper option, the total of investment and administration fees has reduced by approximately 32%. We've introduced a tax refund of 15% of the annual percentage-based administration fee. So an example of this benefit is that an Energy Super member with a super balance of $150,000 in the MySuper investment option is now benefiting from an annual reduction of total fees and costs of approximately $337. For pension members, we've also reduced the annual percentage-based administration fee from 0.22% to 0.18%, so savings for our pension members are even higher. Moving all members to one brand, Brighter Super, in the near future will allow the group to reduce marketing and administration costs, which will be another driver of continued reductions in fees and costs. At the same time as lowering our costs, we've delivered better services for our Brighter Super members. And again, when I refer to Brighter Super members, I'm talking about those who were LGR Super members. We've introduced two new investment options, a low-cost index balanced option and a socially responsible balanced option. We launched our new mobile app, giving members an easy, convenient and secure way to manage their super. We've added new features and enhancements to Member Online. These features and further new investment options will be available in September to Energy Super members as part of moving onto the Brighter Super brand. We're proud to be a medium-sized boutique fund, which means we can remain close to our members and continue to provide a personalised service. Since our merger in the past 12 months, we've met and spoken with 18,500 members, many of whom work in the local government and energy sectors, and have delivered over 2,300 financial advice appointments. Amazingly, the team has answered almost 91,000 calls into the contact centre. We continue to invest in our member services across more than 200 locations and have expanded our regional presence across Queensland with teams located in the central and northern regions. The Brighter Super Group remains not-for-profit and member-owned, operating the same fund structure that LGR Super and Energy Super have enjoyed since their inception. Everything we do is for the benefit of our members and not shareholders. With more than 100 years of combined Queensland heritage, local government and the energy sector remain as important to us as ever and will always be a significant part of both our history and our future. Brighter Super, formerly LGR Super, will remain the default fund for local government, as we have been for 57 years. Energy Super has been the trusted superannuation specialist for the energy sector for more than 40 years, and we're committed to our foundation fund members, along with the industries and employers where they work. So what's next for Brighter Super? As we head into the rest of the year with high inflation and continued uncertainty, Brighter Super will continue to find unique ways to benefit and enhance the lives and super of our members. As we've discussed, our new branding, which has already changed for LGR Super members, will change for Energy Super members in September. For Energy Super members, there will also be a transition to the administration platform, One System. This means there will be changes to your member portal and mobile app. This unification of our systems is another important part of delivering the cost savings and improving our services for you. So there will be communications to all Energy Super members in the coming months about these changes. We'll also continue hosting events like these and keep our personal connections with members. I encourage members to attend these events and reach out so you can feel part of this journey as much as we do. So I'll now hand over to Mark to provide an economic and investment update, and at the conclusion of that, Mark and I will be pleased to answer your questions. Don't forget to submit them by pressing the little blue hand on the top of your screen. Thank you.
Thanks, Kate. This evening, I'm going to talk about the investment outlook by giving context for what is going on, what has been driving the weakness that we're seeing in markets. I'm going to talk about 4 mega trends which have been really dominating markets, not just in recent years, but the trends have been dominating over a number of decades. After I've done that, I'm going to have a look at where were we before COVID, how did COVID change things and the policy response from governments, and where does that actually leave us now? First of all, I think it's important to put in context that investment is a long-term business in terms of generating returns. And this chart shows you the experience since 2009. Over this period, I'm using the My Super Fund, it shows a return of just over this period, just a little bit shy of 8%. It shows that there are significant ups and downs through that period, but the key point is that markets are volatile, and that as I go through today's presentation, it's important to keep in mind that markets are inherently uncertain, and that certainty comes in the longer run, but not over that shorter term. If we actually look at the first megatrend, which is about stable inflation, well, we've had stable inflation over the last 30 to getting on to 40 years around the world, and in this chart, I show the United States, it's the red line, and Australia, which is the blue line. If we look at it, what you can see is that after a period of stable inflation through the 80s and the 90s through to really in the last 12 months or so, there's been a very significant pickup. That stable inflation was something that markets had continued to expect would go on. But as you can see through here, if you look back in the middle part of the chart or go back to the beginning of the chart, there have also been significant periods when inflation has been high, and that this has significant effects on markets. And one of the key drivers of where markets have gone is this pickup in inflation, and where they're going to go will be driven by this as well. The impact of inflation on markets, and in this chart I'm looking at share markets and I'm looking at bond markets, is significant and profound. This is a very long run chart. It goes back to the late 1800s. The blue line is a valuation measure of the US share market going back to the beginning of the time period. And what it actually shows is the price of the market relative to the earnings. So the higher it is, it means you're paying more money for a given amount of earnings for the US share market, which of course is made up of a whole range of companies. The thing to note with the red line is that this is the US 10-year bond yield. And you can see that in 1981, it peaked at around 16%. This followed a very big pickup in inflation after inflation had been steady for a lot of the post-World War II period. Inflation then peaked and then came down significantly. And in the chart, you'll notice that in that period when interest rates went up, inflation was high, the blue line, the valuation measure, dropped. So the share market experienced poor returns. When inflation came down and bond yields began that long-run journey, and it's been a 4-decade journey, you can see that share markets have actually consistently risen through that period. And on average, while it's been volatile, on average have been more highly valued than they were in the preceding period. From this, you can see that what goes on in bond markets, what goes on in the economy, inflation, and what goes on in share markets is actually quite closely linked. Another mega trend to keep in mind is about globalisation. This chart here shows the share of production in the world economy which is actually exported. Post-World War II, you can see that there's been a very steady upward trend. Now, this has been very important for the global economy because it meant increasingly as the world became more integrated, it became more efficient, and it actually was a key driver working to keep inflation down. But we can see at the end that we're beginning to see that a levelling out after really 70 years of increased integration in the world economy. And so that important bringing together of the world and improving productivity and lowering costs and lowering prices does seem to be coming to at least a pause at the moment. And that's also important in the context of when we consider China. Of course, clearly China has been really the big story for the last couple of decades. What these charts here show you, if we look at the chart on the left, it shows the blue line is the value of US GDP or output of the economy. The yellow line is actually Chinese GDP. Go back 30 years ago, the United States was far in advance of where China was. But if we look now, we've actually got China being in total value of their economy around 70% after only being a fraction of the US. The chart on the right shows it in terms of per capita or per head terms. China is still lagging after you adjust that it has a much larger population. But this mega trend was a real key driver of the previous one, which was also that integration of the world and China becoming, along with preceding it, we saw in Japan, we saw in Korea, we saw in Taiwan, a range of countries who actually joined the world economy and actually drove that increase in trade and also provided increasingly cheap goods for countries all around the world. Those key megatrends, in my mind, really provide the context of what has been driving markets if we take a decadal view, and I think that's important at this point in time to do. So, where did that leave us in the pre-COVID world? What it actually it left us where initially, that after 40 years of declining inflation and declining interest rates, it left us a world where real interest rates, so that's interest rates after inflation, were negative. It provided very low nominal interest rates, and inflation was also undershooting the level that central banks wanted to achieve. At the same time, while we had low inflation and low interest rates, it wasn't rekindling growth. There was this concern about what some economists have called secular stagnation. That is, that the economy grows, but not fast enough really to make a big difference in terms of boosting wages, or as it has been in the case for Australia, up until recently, the unemployment rate had been really stuck around 5% in Australia since the end of the GFC. The combination of all this, lower interest rates, low inflation, also saw asset markets, and I've shown you earlier about how the share market with sharp falls in interest rates over a very long period of time has been a key driver of actually pushing up the valuation of share markets. And that, as I said earlier, that lower inflation pushed bond yields down. That's the pre-COVID world that we were in. It was one where interest rates were low and growth was okay, but somewhat disappointing. But asset markets were doing well. Then came COVID. And of course, in terms of the COVID response, one of the unique aspects of the episode was all to do with lockdowns, something we hadn't experienced before. And because of those lockdowns, and they were being imposed by governments, the policy response changed. There was more of the same in terms of interest rates going to zero pretty much everywhere. But what we saw was a significant move by governments to run big budget deficits as they attempt to support consumers, households, and businesses by providing support for the shutdowns that they were imposing. And what we also found at the same time was that governments did something that they hadn't done for many, many decades, was that they directly funded those budget deficits by printing money. The impact of this, and I'll have a few charts will explain this in a minute, that what we saw was an unprecedented increase in demand, particularly in goods, and I'll illustrate it with the United States. There was very strong demand coming about at a time when, of course, what we had was an economy which was struggling, or some parts of it, particularly the service sector, because of the shutdowns. To elaborate on that a little bit more, this chart here shows for Australia the cumulative value of bank deposits since the beginning of the crisis. If we look at the black line, it's actually for households, and it shows that over the period up until the last few months, $281 billion of additional bank account value was built up. For non-financial corporations, it was $178 billion. That's around 25% of the value of the Australian economy. So households in Australia found that during this period, getting significant support, the uncertainty, built up large amounts of money in their bank accounts, and actually have firepower there to spend. In the next chart, where I actually show you what happened in the United States, the profound impact and what I showed you earlier in terms of increased bank deposits through government support was also the case in the United States. This chart here, if you just focus on the red line, it shows you the volume of goods demanded in the United States. If you look where the level of demand was at the beginning of 2000, and then go just 1 year ahead, the level had risen by 25%. And this is the important thing to keep in mind, is that this normally goes only up by 2 or 3% per annum in the United States. There's been a really significant increase in demand coming through. And while it started to come back as service demand is beginning to rise, it nevertheless is still well above the trend. So when we look at what has been one of the major characteristics on the economy after the initial shock of decline in output as we had the shutdowns and then the rebound, what we've seen is that this shift in demand away from services towards goods has actually been a key driver behind the supply chain issues that we've had in the world. Because we've had, on the one hand, a very big increase in demand, but then, of course, as we know, that there've been shutdowns in production, whether it's actually in factories, whether it's been difficulty in terms of actually shipping goods around the world. The cost of shipping goods has gone up tenfold over this period of time, and so this is probably the first key impact to keep in mind when we look at the next chart, which is about inflation. This shows inflation back to 1990 for a range of countries, including the United States, Australia, New Zealand, and the UK. And as you can see, we're all in the same boat. We're all experiencing higher inflation, but to varying degrees. In fact, Australia is actually at the lower end of this group of countries. But we've all been driven in part by the same type of drivers, and that has been on the one hand to do with strong demand coming globally, at the same time that there are supply disruptions. And that's one aspect which initially we saw central banks and governments around the world thinking, oh look, it's just a supply disruption impact. Once we actually have an end to these supply disruptions, we're going to see inflation come back. The next part of the story, though, is when we also look at what's going on in commodity markets, and there are probably two stories to this. The support that governments gave to demand around the world, in the United States, Europe, Australia, supported economic growth, and that kept economies growing and put some upward pressure on commodities. But the real change, and the other supply shock which came through, which is quite profound, really was to do with the Russian invasion of Ukraine. The charts I show here, on the left, you've got energy prices. You can see there we've got gas, we've got oil. We've got coal, and those prices have gone up very significantly. They're beginning to come back a little bit in the last month or so, but generally remain very elevated. And it just wasn't energy, it was also in other commodity markets as well. And we can see that there's been significant pressure, whether it's a hard commodity used in production or whether it's actually food. We can see there that this big increase in commodity prices, and given that energy is critical for production, it's critical for us driving around our own cars, the transport of goods, for the food we eat, it's actually been the other key supply side shock which has come through, in addition to what's come through from just disruptions to production and shipping of goods. The next element as well, and the part where there is a real focus, and where central banks around the world are really focused on, it's actually that we're running economies around the world where unemployment is very low. If we look at the chart on the left, it shows the unemployment rate in Australia. And now, at the moment, it's the lowest since it's been in 1974. The chart on the right shows you the unemployment rate in the United States. And what it shows is that unemployment in the US, similarly, is down at one of the lowest levels that it's been in the last 50 to 60 years. And this is critical because when we look at the way that these type of shocks which come through to the economy, supply is disrupted, commodity prices are up, the way that it gets transmitted into the broader economy comes through what happens in the labour market. And when you've got low unemployment, wage pressure can increase. And while in Australia it's only beginning to turn, in the United States, the increase in wages has been quite significant. And I've got a chart a little bit later to make that point. And so if we look at this, what we've had is a situation of a combination of supply shocks coming through in production, in shipping, it's coming through shocks in commodities, and with one of the world's major commodity producers, Russia, being shut out from Western markets because of the invasion of Ukraine. And then the overall demand response, a strong demand in economies in Australia, in the United States and elsewhere, has also seen low unemployment, working to drive up inflation in more ongoing sense through higher wages. And one of the things which you may have seen is that central banks, including the Reserve Bank and the US Federal Reserve, are beginning to raise interest rates. And they're doing it quite rapidly. And in Australia, it's the most rapid since the 1990s. A phrase which is used to describe where central banks are relative to where they should be is, well, if you're a bit slow out of the blocks, you're behind the curve. And I tried to show it through this chart because it gives you a good history of what the US equivalent of the RBA cash rate, the Fed funds rate, which is the black line, relative to wages. And as you can see, normally when wages, the red line, moves up and down, there's generally been a pretty close correlation. And that central banks, when they see wages going up, they feel we've got to actually have, and fairly quickly, get interest rates up. The problem we have at the moment, as you can see, is there's a big gap there. And there's a very large gap there, which indicates that central banks are late to raise interest rates. And that's the same in the US as it is in Australia, as it in Europe, and in a number of countries, or a lot of countries around the world. And so this is the reason why we're seeing central banks beginning to raise rates quite rapidly. So what does that mean for markets? Clearly, it means that interest rates are going up. And we're already seeing that with expectations that in Australia, we could see the Reserve Bank taking rates to 2.5% to 3%, and similar levels being achieved in the United States. So when thinking about share markets, what it means for share markets, it can be quite significant. The chart on the left shows you, it's a similar chart to what I had earlier about the price-earnings ratio of share markets around the world. And what you can see here is that in the last 6 months or so, there's been quite a significant decline coming through in markets. And what's driven this? As interest rates have gone up, it's actually it's made the relative attractiveness of share markets decline as interest rates rise. But the other thing which is starting to really worry markets now is that as interest rates go up, it's going to slow the economy, slow the global economy, and that the risk of recession is rising. The chart on the right shows you the earnings series which are used in the chart on the left. And so to actually get a decline in the PE ratio, the price can decline or the earnings can go up. In this case here, you can see that the general expectation in markets at the moment is that earnings are going to continue. Maybe they'll slow in terms of the pace of growth, but go up. Markets are beginning to adjust down that there are risks there on growth in the global and the Australian economy. But in my mind, there's probably still a little bit further to go in terms of that adjustment. And so the combination at the moment of what is driving share markets down at the moment is that higher inflation, the central bank response, the increasing interest rates which make share markets less attractive, but also start to undermine the earnings which support the price which company share price is maintained at. So where does that leave us in terms of are we going back to normal, or is there a new normal? And the chart I've got here on the right, it probably don't see it that often in the newspapers or online these days, but it actually shows you Apple mobility data, and it just reminds you of what was happening around the time of the initial COVID impact. And since then, as we've actually seen the COVID virus spread and then wane and then spread again. And at the moment, we seem to be going through another wave of sorts at the moment. While vaccines have actually clearly made things a lot better, nevertheless, it's having an impact. And particularly at the moment, China, which is trying to attempt a zero COVID policy, is actually much more responsive in shutting down than what we're finding in Australia. But nevertheless, this new normal period that we're in at the moment is one where there will be uncertainty about the course of COVID. Markets typically, when they find news, they actually tend to factor it in. They may fall and then move on. Global crises normally, in a geopolitical sense, tend to normally hit and then fade in the impact. But this one does look to be more enduring. This one has been playing out over a couple of years, and in terms of trying to assess what that new normal look like, I think it's certainly going to be different to the one that we've been through in terms of the backdrop around health. But I think it's also going to be one around the economic environment, and that it's one where we're moving into one of somewhat higher inflation and much more aggressive policy by central banks. So, what to do in markets? One of the great lines about investing, I mentioned earlier, it's a long-term game, and another one is that it's time in the market that matters. It's not timing the market. Now, if you look over the last 30 years, the Australian share market's had a return of around 9.5%. Now, if you actually had perfect foresight, and you could miss the 40 worst days in the share market through that period, you would have generated a return of 17.5%. So, if you've got a very clear crystal ball. But if you actually got it wrong and you actually missed out the 40 best, you would have only generated a 3.3% return. Now, we build portfolios which can maintain, which will perform well across a range of environments, but the ups and downs of markets, as my earlier charts showed, are just a thing about markets, about that uncertainty. And that uncertainty means that it's important to actually remain invested in markets, because as just this simple illustration shows, if you actually, it's great if you pick the times to be out, but if you miss the good times as well, it also impacts. It's better to stay invested in the market, because over the longer run there will be strong positive returns, but you need to be in the market to achieve those. So, in terms of to bring the presentation to a conclusion over the next couple of slides, firstly, just about the returns of the fund. Over the last decade, as I mentioned earlier, and I showed you the chart of the longer MySuper performance, that the returns over the MySuper fund has just been shy of 8%, and this the equivalent type of funds choice options we have as well. In the past 12 months, if we look at the MySuper option and across the funds, all of the diversified funds generated negative returns. And to use MySuper as an example, it was down by 3.8% in the financial year. But in the context, of course, over the longer run, the fund had generated return just shy of 8%. In terms of the peer positioning of our funds, if we go back to the latest super rating survey, which came out with the May data, it showed that most of the options that we have across the Brighter Super Group have actually been above the average fund performance, so solid performance. And if we also look at external raters as well, Super Ratings and Chartwest, they actually have high ratings on our fund, given our process, given our performance, along with our member service. So to bring my presentation to you to conclusion, the key thing to understand in the current environment is that we've been hit by a series of supply shocks in terms of commodity production, market access, global shipping and goods production. But at the same time, along with supply, we got hit, given the nature of government support, because of the COVID shock, by support, which was actually seen demand growth around the world increase quite significantly. Central banks, along with governments, have provided significant stimulus, and so provide quite this combination of shocks and government support has really provided quite a fertile environment for what we've actually seen, which is for an uptick in inflation. The uncertainty at this stage is just for how high will it go and for how long, and that will be a key determinant of where markets are going. Russia, in terms of its invasion of Ukraine, has just added on top of what was already an environment where the response to COVID, along with supply shocks related to it, were already going to push inflation up, but it's only just worked to push things up further. To me, it means that this period of disappointingly low inflation, from being too low, has now moved to one where it's high. So I think what it means is that as central banks work to catch up, that period of low interest rates is behind us, at least for a period of time, and depending upon how successful central banks are at bringing back that inflation. When I look across over the next few years, to me it looks to be a period where returns are going to be lower than what we've expected. The volatility that we've got in markets at the moment is one reason why we actually, in our portfolios, we have diversification across different asset classes. We have diversification across different managers, and use active management where we see that it adds value in our portfolios, to actually build portfolios which can actually guide you through the ups and downs which are inevitably going to happen, and for the different type of market environments which will present themselves. I might hand it back to you, Kate.
Thank you very much, Mark. Always interesting, I have to say. And thanks to everyone in the audience once again for taking the time to attend tonight's webinar. So we're going to be taking questions now, and don't forget, we want to hear from you. Please click the little blue button on the top of your screen. We have a number that have already come through, so I'm going to start with one for you, Mark. A great question from Trevor. Given the increase in interest rates globally and falling asset prices, have the unlisted investments in the funds been revalued to reflect the current investment environment?
One of the differences clearly between the listed and the unlisted is that the listed do move day by day, whereas the unlisted have regular, could be quarterly or maybe half yearly adjustments. What we're seeing at the moment, though, is that we're seeing so far this year, as markets are weakened off, we've begun to see that those unlisted investments in a lot of cases have begun to level out after very strong returns. Private equity has provided, for example, very strong returns over the last few years, but is beginning to lose steam. So we're beginning to see adjustment, but generally there tends to be somewhat of a lag in terms of the adjustment, in terms of feeding through to the unlisted assets. So over the longer term, they're going to have very similar movements between listed and unlisted. But we have begun to see the early stages of that adjustment coming through.
Thanks very much, Mark. I'll answer the next question. A great question from Tony. Why has the capital managed fund been changed from medium risk to high risk when there's no alternative available? It appears that the changed investment mix occurred with very poor timing. Did the capital managed fund merge with other investment products from merged funds? And if so, which options? That is an incredibly good question, Tony, I have to say. This is an industry problem. So we demonstrate our risk on each one of our investment products using an APRA-regulated methodology, which is called the standard risk measure. And that is the number of negative return years that you are expecting to see from that option over the next 20 years. You heard from Mark where he said that he was expecting returns to be lower across all asset classes. But you also heard from Mark that there was extraordinary volatility, and that's one of the reasons why diversification is so important. What that means, though, is that if you have a lower average return for each one of your asset classes, all of the asset classes are impacted, but you have a lot more volatility around that average, then the likelihood of your getting a negative return has gone up a lot, if you just think about the way returns wobble around a lower mean. Now, what that means is that number of negative returns in 20 years across every one of our investment options, and in fact, this occurred right across the industry, has gone up. And the asset allocations are the same. So we would say that the long run investment risk is similar to what it was before they were revalued. However, under the standard risk measure that APRA sort of tells us how to do the methodology of, obviously the risk does go up because we do expect to have more negative years over the next 20 under that set of scenarios. So we haven't merged the investment options to cause the risks to go up. The risks have gone up because there's more volatility and there's lower expected asset class returns over the next period of time, and that just plays out that way through the methodology. So really great question. Thank you for it. Certainly, if you look across the industry, you'll see that that is a common thing that has been experienced across not only our investment options, but many industry investment options. So next question for you, I think, Mark, and this one comes from Andrew. We're keen to know the performance of our investment options. Why have some done better than or worse than others? Also, why are the changes to our investment options now being offered? And many of you will have heard from us quite recently on significant event notice.
When looking at the different drivers across different funds, and one of the key drivers is really going to be down what the asset allocation is. What's the amount of shares that are in a portfolio? What's the amount of fixed income? One of the characteristics of the current episode is that normally when you have a more conservative type of fund, it tends to be the returns tend to be less volatile, but they also tend to be stronger during weaker phases of share markets. But what we've actually found in the current episode is that we've actually had quite weakness coming through in both funds which have a heavily weighted into equities, along those funds which are also heavily weighted into bonds, and that reflects that unlike the last 20 odd years when interest rates have tended to they move in the direction where when the share markets go down, interest rates fall as well. Interest rates now have been driving the weakness in equity markets when they go up. So the difference across options that we've been getting to a large extent comparing a fund with a lot of shares to bond markets really comes down to that difference in terms of the allocation. But there's actually not a lot of difference when you look across the different risk buckets in the performance in the past 12 months or so.
Thanks very much, Mark. Another question which I'll answer, and that is from Nick. We note that Australian Super indicated through the press that they'll move to a defensive proposition. Sorry, I thought this was about the product, but actually it's about SAA, so I might give it to Mark. We note that Australian Super indicated through the press that they would move to a defensive positioning. Is Energy Super considering this? and has this been implemented, and if so, how?
When looking at the defensiveness in a portfolio, there can be a number of ways that can actually occur. It can be by running the allocation to growth assets, and particularly this is going to be in listed share markets, to be running that say significantly below what the stated long run allocation, the strategic asset allocation is. And at the moment, the way that we're actually maintaining our funds around the long run allocations to our equity holdings. So at this stage, we're not running what we call an underweight to share markets. But what's also important in these type of environments, it's not just about the defensiveness. It's also about the type of manager that you have. And one of the things in terms of which is important for share markets is the different style of managers which we have as well. And one of the things we've been working on in our portfolios is actually to build better quality managers, better performing managers into our funds and for the environment that we've got ahead. So at this stage, as I said, we're running our portfolio not in a big tactical sense underweight. We're not doing that. We actually have been focusing particularly on the manager lineup, so that's the response that we've had to that.
Thanks very much, Mark. Now, another question, and I will say, don't forget this is general advice only. Mm-hmm. Is now a good time to put extra money into super?
General advice. If I go back to that slide I had about its time in the market, not timing the market. I think that's probably a good place to start. That it's actually getting into the market, the ability to pick exactly the bottom. Everyone would like to be able to pick the bottom. Great investors such as Warren Buffett will tell you that look, it's impossible to do that. And so I think the main thing about superannuation is to continue to invest your money into it. Market may go down. It may go up, but over the long run, it's all about building returns on returns, and that sort of compound interest, compounding returns, which will build up your wealth over years. And so I'd say at the moment the key thing is not really time to try to time the market. What you can say is at the moment that the US share market's 10% or so less than it was back earlier in the year. So I'd say superannuation is something that you should just continue to plug away at and don't try to be too cute around the timing.
Thanks very much, Mark. So a lot of interest actually in our investment update, given the volatility in the markets. Don't forget to send us more questions. Press on the little blue hand on the top of your screen. So I've got a couple more for you, Mark. So the first one comes from Daryl. Did I see that more aggressive options seem to have shown less losses than the more conservative options, and isn't that against the norm?
That comes back to my comment earlier, question about what drives differences in performance across options, and what you have picked up there, that's normally the case. Normally the case is that when you have or at least in recent decades, you have up and downs in markets. It's the share markets which go into a bear market, and interest rates fall. And for bond markets and in conservative options tend to have the steadier investments. And when interest rates fall, bonds get valued up. And so if you've got a lot more bonds, what it tends to do, it supports you. But this time round, the difference is that the weakness coming through in share markets has been very much driven by inflation picking up, interest rates picking up. And therefore, what we've actually found is, in fact, if we look so far this year, it's the bond markets have tended to be weaker than actually equity markets, particularly after you take into account the impact of a falling Australian dollar. So it is unusual, but in recent decades, but that's what's played out.
Thanks very much, Mark. So a question from Phil. Phil asks, is this presentation given in lieu of annual visits to the member areas in Queensland? and can we cite a return table on all investment options? So first of all, I can certainly say that this presentation is not given in lieu of our annual visits to all areas in Queensland. We're in the process of setting those up now for the next couple of months. In respect of the investment options, those will be available to you, certainly through the annual report. We'll make them available through newsletters, etc. So they'll be definitely made available to you, but we don't have them now. So another question for you, Mark, and this one comes from Jeffrey. With lower returns expected on asset classes, do you see lower long-term averages going forward, or will active management continue to undergird the average returns we've seen in the past?
I think what we're going to see is that if we look over the last 35 years, we've had real returns in the vicinity of around up towards 6%. So there's been really strong real returns, and that reflected the fall in interest rates and assets being valued up. Whether it's bonds, whether it's equities, they all loved the decline in interest rates in terms of boosting value. So that has been the drive there. Looking ahead, I think we're reaching one of those secular turning points. I think we've reached one of those on inflation after a long period of lower inflation, falling interest rates. And what that means for me, given the importance of interest rates in terms of valuing assets, as we go through that adjustment, to me, it means that we will have weaker returns than what we've had in the last few decades. The one positive to say, though, going about bond markets is that the increase in interest rates have actually does now start to improve the returns for bond markets, because interest rates are up off the floor, and that will actually be a positive in time for defensive options. But all up, I think on average, real returns will be lower. Active management will be a key part to help make up for that, and active returns will be a larger part of the total return if we continue to pick managers which perform successfully. But I don't think in itself it will actually make up all of that decline in real return from what we've actually seen in recent decades.
Thanks very much again, Mark. So lots more questions coming through. Keep them coming. It's fantastic. So a question from Kwong: is diversification built into individual investment portfolios? For example, is there diversification in an international shares only portfolio? Or are you referring to the MySuper investment option or the other diversified options which have different percentages in different assets?
The diversification, if we take share markets, the diversification in shares comes about a number of ways. In terms of if we actually look at the MySuper, in the MySuper fund, the share exposures for Australia and global shares are made up of index or passive investments, but we're diversifying across Australian and global markets. And one of the diversifiers we've got in there as well is that we carry most of the shares in the portfolio as unhedged. And so what you'll find is, while there are the correlation between Australian and global shares, because they're different markets and because the currency provides diversification. If we actually look into other parts of the choice options, what you'll see there is that there's more of a mixture there of active managers and some passive passive strategies as well. And within the active managers, we will actually have a variety of managers, some which may have a quality growth bias, or some who you would regard as a value manager, for example. So we'll have different type of managers. And the other thing as well is that we've got, even you can have managers of the same style and they can do somewhat differently because they've just got a somewhat different process. So across the portfolio, there's a range of ways we do it across markets as well as across different type of managers.
Thanks, Mark. So would you say then that there is diversification within an individual asset class, but how much of the return impact is going to come from the asset class itself and how much will come from active management?
What you're looking at in terms of the active management, if you're looking at shares and the return. What you're looking at the moment, the longer run return expectation you might have, it could be somewhere in the vicinity for global shares of maybe around, say, 5% at the moment. The type of managers we employ, achieving an active return of a couple of percent above that would be the type of target that we'd expect once we combine our managers. So 2%. So, and this is the important thing: as returns have come down, that 2%, which might have been achieved before, is actually now more important. So it's a combination of both, which is coming through.
Thanks very much, Mark. So a couple more questions we have time for. First question from Norm. Do you see deposit interest rates getting as high as they were in the 1970s and 1990s?
I can remember when there were term deposits. I think they were sort of around 17%. We had bond yields up to around 14%. I don't think inflation will go to that type of levels that we actually saw back in the 70s and into the 1980s. The way that we've seen central banks rapidly respond, they've realised they've made a mistake in letting things go too long, or they're behind the curve, as I mentioned. So I think what they're doing is they know the mistake, that if they let it get on top of, if they don't react aggressively to inflation, it can become more entrenched. And so I don't think we're going to see inflation get to those type of levels. I think we've learned from that. But one of the issues is that getting that inflation down may actually take some pain, and that's going to be one of the difficult things for economies and societies to put up with. But even if it is in the long run best interest of actually getting on top of it. So no, I don't think they're going to be that we're going to have interest rates quite that high, but I think they're going to be higher than what we've seen in recent years, and I've got no doubt about that.
Thanks very much, Mark. And given the time, this is our last question. So this one comes to us from Shane. Great question, actually. Another question for you, Mark. Given the massive deficits the Australian government has incurred in COVID-19 response, is there a heightened risk to the superannuation environment in terms of disfavourable taxation treatment compared with today's situation?
I think the budgetary position of the government at the moment, if we look at the overall thing in terms of the level of debt compared to many countries around the world, we're still in a great position. But normally we've run a pretty tight ship here, and that we've actually had fairly disciplined government. So I think we're going to see across the board that there will be a focus on spending, there will be a focus on taxation as well. And superannuation, probably won't be missed out of that. But I know that there's a lot of commentary over the time that when super's been tampered, been fiddled with in terms of tax rates, it's a long run game. We need to maintain confidence. So I think there'll be focus on tax, there'll be focus on spending. Super will be one of them, but it won't be the only one.
Good on you, Mark. I love the fact that he's always prepared to have a go. It's great. So, time to finish now. But before concluding, I wanted to remind you that our fund is not just for those in local government or the energy industry, but is open to everyone. So to learn how your spouse, friends or broader family can join us, go to brightersuper.com.au or energysuper.com.au. So that draws to a close our webinar this evening. I do hope this presentation was beneficial for you and that you can see that we'll continue to work hard for your best interests. Thanks again for attending and have a terrific rest of the evening.